What if governments aren't just addicted to debt, but trapped by it? You've just watched the Financial Times video, Why Governments Are Addicted to Debt. And here's the shocking truth. Debt isn't just numbers on paper. It's like an ant colony borrowing sugar again and again, until the pile is so heavy, the entire nest exists only to pay it back. So here's what you must ask yourself. Are the US, Japan, and Germany each walking into the same trap or different ones? Why did a tiny 0.25% Fed cut shake the whole world? Is this really a lifeline or the start of a global recession? Stay with me, because what FT didn't explain, we're about to uncover. First, let's briefly understand why governments have to borrow. No government has enough tax revenue to meet all the needs of society. Welfare, healthcare, education, defense, infrastructure, all are enormous. In war, the COVID pandemic, or a financial crisis, governments have to spend more than ever. But raising taxes causes fierce reactions. Cutting spending loses public support. So the easiest choice, borrow. Like ants borrowing sugar to survive the rainy season, governments borrow to get through economic winters. Borrowing is not necessarily bad if used for long-term investment, like building roads, hospitals, or researching technology. But when borrowing to pay pensions, subsidies, or to firefight routine spending, debt will swell without creating new revenue. Okay, so every government borrows. Then the borrowing mechanism will be in what form? It is through government bonds. Governments borrow through bonds. The Treasury issues a paper promise. Investors buy in exchange for interest. Banks, pension funds, insurers, even foreign central banks all line up to buy. Why? Because bonds are considered the safest. Why are they considered the safest? Because every government can print money to pay debt, especially the U.S., because the U.S. is the only country that can print dollars, the global reserve currency. But safe does not mean unlimited. When debt is large, the market begins to doubt the ability to repay, demanding higher interest. Just like when ants borrow too much sugar from many colonies, the lenders begin to ask for more sugar interest to cover risk. But from one period to another, old debt is not yet repaid. The government borrows new debt, making debt swell bigger and bigger. Then what? That problem impacts macroeconomics. In what way? At that time, it will create 4 serious consequences. 1. Interest costs soar. Interest becomes the biggest burden in the budget, taking away from healthcare, education. 2. Crowding out. The state borrows a lot, sucking up capital, making system-wide interest rates increase. Businesses, individuals find it harder to borrow. 3. Refinancing risk. Debt maturing in high-rate context equals double shock. 4. Confidence loss. If investors lose trust, currency devalues, interest spikes leading to debt crisis. This is like when ants keep borrowing sugar. At harvest time, the sugar to be repaid is more than the harvest itself. Instead of feeding the nest, every drop of sweat goes to debt. FT mentioned 3 typical countries, the US, Japan, Germany, showing 3 different debt paths. The US is the only country that can print USD and has exorbitant privilege because the US has the global reserve currency. They can borrow more because the world needs USD, but twin deficits, including both budget and trade, make the US always issue new debt. The U.S. bond market is the largest sugar nest on the planet, where other ant colonies bring sugar to deposit. Japan, domestic debt, and BOJ. Japan has the highest debt GDP in the world, but mainly held by Japanese people. The Bank of Japan controls yields, keeps interest low to maintain the system, but the consequence is the yen weakens, loses value on global markets. Germany, fiscal discipline in the Eurozone. Germans have strict fiscal culture, debt break. But because in the Eurozone, Germany cannot print money, must rely on ECB. Bunds, German bonds, are considered the purest sugar, safest in Europe. Difference: the U.S. relies on monetary dominance, Japan relies on domestic, and BOJ, Germany relies on discipline. But all 3 face one common issue. When debt swells too much, the system can break if interest rates change suddenly. So, when does public debt become worrying and can cause recession? Public debt itself is not always bad. Like ants borrowing sugar to survive rainy season, if the sun comes and ants harvest enough to pay, then nothing to fear. The problem only arises when debt swells faster than harvest ability. There are 3 signals public debt is really dangerous. 1. Debt grows faster than GDP. If debt grows 7% per year, while GDP only grows 2% per year, debt over GDP ratio escalates. At that time, tax revenue cannot keep up with interest cost. Government must borrow new to pay old. Death spiral. 2. Interest cost exceeds core spending. When annual interest exceeds budget for education, healthcare, or defense, the state lives to repay debt, not to develop. The U.S. is nearing this point. Annual interest approximately $1.2 trillion US dollars, equal to defense cost. 3. Market confidence loss. When investors demand higher rates before buying bonds, that means trust has fallen. This is when the spiral can trigger recession. Government cuts spending, businesses can't borrow, consumption drops. Currently, U.S. public debt has exceeded $35 trillion US dollars, the largest number in human history. So what makes it worrying? Debt to GDP of the U.S. is approximately 125% GDP, much higher than the safe 60% EU standard, and approaching Japan, 250%. But unlike Japan, the U.S. relies more on foreign capital, easier to be punished if confidence is lost. About interest cost. With 10-year yields around 4.5 to 5%, the U.S. must pay over $1 trillion US dollars per year. This already exceeded defense budget, and if rates stay high, pressure grows year after year. About debt maturity structure. About 30% of U.S. debt matures in 1 to 2 years, meaning the U.S. must refinance at high rates, rolling the entire old mountain of debt onto the new high-rate slope. This is huge risk. On national credit, Fitch and Moody's have warned about U.S. credit outlook. If downgraded, rates rise more. The debt spiral expands faster. Thus, 35 trillion USD debt is not just a number, but a red warning. The U.S. can endure longer thanks to USD as reserve. But the question is, at what point will markets stop believing promises? That is the threshold that can trigger global recession. Why is this important for the global economy? Because when debt swells enough, governments must choose: print more money, cause inflation, or cut spending, cause recession. Both are painful. U.S. Treasuries are the global benchmark. If the U.S. faces debt problems, the entire system, from stocks, housing, to Bitcoin, shakes violently. This is like when an ant colony borrows too much sugar. One day, all labor goes to pay sugar interest for others. If the largest ant colony, the U.S., collapses, the whole forest of ant colonies shakes. So why doesn't the U.S. print money to pay debt? If the U.S. prints money to pay debt, trust in USD collapses. The reserve currency loses value, inflation spikes, and the world financial system trembles. The Fed can buy bonds, QE, but that's only temporary, not erasing debt. The U.S. must keep the image of a trustworthy ant nest, so other ants keep depositing sugar. But this is also why the U.S. government urges the Fed to cut rates. Annual interest costs have risen to trillions. If yields stay high, new debt crushes the economy. On September 17, 2025, finally the Fed decided to cut 0.25%. But is that move to help the economy recover, or is it a signal of recession? Cutting 0.25% can be considered a signal. The Fed admits the economy is having heart pain. This is a move to calm markets, but not enough to solve the root. Like giving ants just a pinch of sugar while the whole colony needs tons. If the Fed cuts fast, strongly, liquidity is saved, housing, stocks, BTC bounce in short term, but inflation risk returns, USD weakens. If the Fed cuts slowly, maintains trust, restrains CPI, but government and business debt costs choke growth. Recession can happen due to sugar shortage in the colony. The core problem, cutting 0.25%, is not enough. It's pain relief, not cure. Recession may still come because the disease is swelling debt, not just high rates. So what if the Fed cuts fast? Front-loaded cuts, e.g., continuous 0.5 to 0.75% reductions. This shows the Fed panics due to systemic risk. Short-term, stocks boom, risk on, especially tech and growth. Housing recovers thanks to lower mortgage. Crypto and gold explode because USD weakens. Inflation risk returns. But risk exists. Markets read that economy is in serious trouble. Confidence falls, capital flees. USD, long yields may spike, bond vigilantes strike back. This is like ants facing storm, instantly borrowing huge sugar to survive. Short-term food, long-term bigger debt pile. Case Fed cuts slowly, conditionally. Gradual cuts, 0.25% steps, weighting CPI and jobs. This shows Fed is cautious, wants inflation control first. The outcome: stocks recover slowly but stable. Housing remains hard short-term, mortgage high longer. Gold and crypto rise but not explode. But risk: high rates prolonged. Weak firms, defaults rise, technical recession risk. This is like ants borrowing bit by bit, still foraging, still repaying. Less exciting, but safer. If Fed keeps rates high longer, higher for longer, no cut yet? This shows Fed believes economy can still endure. Main worry is inflation back. The outcome: housing weaker, liquidity frozen, high debt firms collapse more, default risk high, stocks may correct, USD strong, commodities and BTC pressured. At same time, a big risk: recession can erupt due to high capital cost. Like ants can't borrow sugar, colony starves. With 3 Fed action scenarios above all have outcomes and risks. We investors like wise ants must follow the ant strategy. Prepare and watch indicators to go one step ahead. Turn crisis, recession into opportunity for wealth and financial freedom. 1. Results of big treasury auctions. 2. Yield curve, steepening inversion. 3. CPI expectations, break-even tips. 4. Financial conditions index, FCI. 5. Flows into gold/BTC/long-term bond ETFs. Always defend by keeping personal debt maturities safe. Avoid floating leverage when rates are high. Diversify, strategic cash, short-term T-bills, physical gold, controlled crypto share, like hunting ants. Attack when signals show. If Fed goes slow, conditional cuts. Favor quality firms, mid-duration. If fast cuts due to stress. Short-term risk on tech, crypto, but strict risk management. In conclusion, ants can borrow sugar to live through rainy season, but if borrow too much, one day the whole nest pays the price. Global governments too. Swelling debt is today's easy choice but tomorrow's trap. The Fed's 0.25% cut is just a sign, a warning bell, not the cure. Will recession come as the U.S. continues to feed its debt with pain relief rate cuts? Do you think the Fed will rescue markets quickly or keep rates high to defend USD? Comment your opinion below the video, and don't forget to subscribe, like, and share to help your friends, relatives know how to act in each scenario to protect and grow assets effectively. Wishing all of you who watch this video can achieve financial freedom.